Picture this. You're standing in your local Starbucks, about to pay $5 for a latte. But have you ever wondered what invisible forces determined that exact price? Why isn't it $50 or 50 cents? Welcome to the fascinating world of economics, where brilliant minds have spent centuries trying to decode the mysteries of money, markets, and human behavior. I'm about to share 6 revolutionary economic concepts that literally shaped the world you live in today. And here's the kicker: some of these ideas are so counterintuitive, they'll completely flip your understanding of how the economy actually works. Ready to have your mind blown? Let's start with perhaps the most famous economic metaphor ever created. In 1776, yes, the same year America declared independence, Scottish philosopher Adam Smith published The Wealth of Nations and introduced the world to the invisible hand. But here's what's fascinating. Smith only mentioned this phrase 3 times in his entire 900-page masterpiece. Yet it became the foundation of modern capitalism. Smith's insight was revolutionary. When you pursue your own self-interest in a competitive market, you're actually helping society as a whole. It's like magic, but with math behind it. Think about your morning coffee again. The farmer in Colombia doesn't grow coffee beans. Because he loves you, he does it for profit. The shipping company doesn't transport those beans out of kindness, they want money. Starbucks doesn't roast and serve that coffee from pure altruism, they're running a business. Yet somehow, through this chain of pure self-interest, you get your perfect latte every morning. That's the invisible hand at work. Nobel laureate Milton Friedman put it brilliantly. Nobody spends somebody else's money as carefully as he spends his own. This self-interest creates a natural quality control system. But here's where it gets controversial. Austrian economist Friedrich Hayek took this idea even further, arguing that free markets are actually superior to any form of central planning. He witnessed firsthand how government control led to economic disasters in Europe. However, and this is crucial, the invisible hand isn't perfect. Markets can take decades to reach equilibrium, and sometimes they get stuck. That's why even the most free market governments eventually step in when things go wrong. Now, here's where economics gets really weird. What if I told you that being responsible with your money, something your parents probably drilled into you, could actually crash the entire economy? Welcome to the paradox of thrift, one of the most mind-bending concepts in economics. The logic seems bulletproof. Save money, banks invest it, businesses expand, everyone wins. Austrian economists like Hayek and Milton Friedman championed this approach. Even during recessions, they argued, saving would eventually lead to investment, innovation, and recovery. But then came John Maynard Keynes with a revolutionary counter-argument that changed everything. Keynes famously said, "In the long run, we are all dead." His point, while saving might work in theory, real people suffer real consequences while waiting for the long-term benefits to kick in. Here's the paradox. If everyone saves during tough times, consumer spending plummets. Businesses lose customers and lay off workers. Those unemployed workers save even more desperately, spending even less. It becomes a vicious cycle, spiraling downward. Think about 2008. As the financial crisis hit, what did most people do? They tightened their belts, paid down debt, and saved more. Sounds responsible, right? But this collective belt tightening made the recession deeper and longer. Keynes argued that governments should do the opposite. During recessions, spend more, not less. Create jobs, boost demand, and worry about paying the bills when the economy recovers, and people are happy to pay taxes again. Paul Krugman, another Nobel laureate, puts it this way: what's true for individuals isn't necessarily true for the economy as a whole. This is called the fallacy of composition, and it's everywhere in economics. The challenge? Convincing politicians and voters to spend during the worst possible time. As Keynes wryly noted, getting people to willingly pay higher taxes remains an unsolved problem even for genius economists. Imagine you're the best lawyer in your city, but you're also the fastest typist. Should you type your own legal documents? Common sense says, yes, you're better at both tasks than anyone else.
But David Ricardo, a 19th century British economist, would tell you that's completely wrong. And his reasoning revolutionized global trade.
Ricardo's theory of comparative advantage is beautifully counterintuitive. even if you're absolutely better at everything, you should still specialize in what you do best and trade for the rest. Here's why. Let's say you can type 100 words per minute and draft legal briefs worth $500 per hour. Your assistant types 50 words per minute but can't draft legal documents. Who should do the typing? You might think, I'm twice as fast, so I should type. But Ricardo says, wait, in the time you spend typing, you could be drafting briefs worth hundreds of dollars. Your assistant might be slower at typing, but they're not costing you $500 an hour in lost legal work. This principle scales up to entire nations. Portugal might produce both wine and textiles more efficiently than England. But if Portugal is much better at wine and only slightly better at textiles, both countries benefit when Portugal focuses on wine and England on textiles. Thomas Friedman in The World is Flat extends this logic. When the world is flat, you can innovate without having to emigrate. Countries can specialize in their strengths and trade globally. But here's where it gets complicated in our modern world. Ricardo assumed that capital and labor stayed within national borders. Today, factories move to Mexico, call centers relocate to India, and software development shifts to Eastern Europe. This creates what economists call factor price equalization. Wages and returns to capital tend to equalize across countries. Great for global efficiency, but it can be devastating for specific communities. The result, we see the benefits of comparative advantage in cheaper goods and global prosperity. But we also see the political backlash in Brexit, trade wars, and rising nationalism. As economist Paul Samuelson warned, even beneficial trade can create winners and losers within countries, not just between them. Here's a question that keeps finance ministers awake at night. Can a country control its exchange rate, set its own interest rates, and allow free movement of capital all at the same time? The answer, according to the impossible trinity, is a resounding no. And this limitation shapes every major economic decision your government makes. Economist Robert Mundell won the Nobel Prize for proving this mathematical impossibility. Think of it as an economic version of pick 2 out of 3. Let me show you why this matters with a real example. Remember the European debt crisis of 2010? Greece wanted to lower interest rates to stimulate growth and reduce unemployment. Sounds reasonable, right? But here's the problem. Lower interest rates made Greek investments less attractive. International money started flowing to Germany and other countries offering higher returns. This weakened Greece's position within the Eurozone and actually made their debt crisis worse. The European Central Bank faced an impossible choice. Keep rates low to help struggling countries like Greece, or raise them to prevent capital flight and maintain the euro's stability. Former Federal Reserve Chairman Ben Bernanke explained it perfectly. In a world of mobile capital, you cannot have it all. This is why Brexit happened, why China controls capital flows, and why the US dollar's dominance is both a blessing and a burden. Consider 3 different approaches. The US chooses free capital movement and independent monetary policy, letting the dollar float. China prioritizes exchange rate stability and monetary control, restricting capital flows. The Eurozone picked free capital movement and fixed exchange rates, giving up individual monetary sovereignty. Each choice involves trade-offs. When COVID-19 hit, the Federal Reserve could cut rates to near zero and print money. The European Central Bank faced more constraints due to the needs of 19 different economies. As economist Barry Eichengreen notes, the impossible trinity isn't just an academic curiosity. It's the fundamental constraint that shapes international finance. Every financial crisis, from Asia in 1997 to the global meltdown in 2008, can be understood through this lens. Economics is a dirty little secret. It's built on the assumption that you're perfectly rational. You always make optimal decisions with complete information, never let emotions cloud your judgment, and consistently act in your own best interest. If you just laughed out loud, you're not alone. Behavioral economists have been chuckling at this assumption for decades. Daniel Kahneman, who won the Nobel Prize for essentially proving that humans are predictably irrational, puts it this way. The confidence people have in their beliefs is not a measure of the quality of evidence, but of the coherence of the story they have constructed. Let me give you a perfect example. During the 2008 financial crisis, many banks made loans they knew were risky. Were they being irrational? Not exactly. They rationally calculated that if things went wrong, the government would bail them out, because they were too big to fail. This creates what economists call moral hazard. When you're protected from the consequences of your actions, you take bigger risks. It's like driving recklessly because you have insurance. But human irrationality goes much deeper. We suffer from confirmation bias, seeking information that confirms what we already believe. We follow herd mentality, buying stocks when everyone else is buying and selling when panic sets in. Richard Thaler, another Nobel laureate in behavioral economics, discovered that people value things they already own more than identical things they don't own. This endowment effect explains why you might refuse to sell your house for the same price you paid, even when the market has clearly declined. We also have present bias. We heavily discount future benefits in favor of immediate gratification. This is why gym memberships spike in January, but gyms are empty by March. We know exercise is good for us, but the immediate cost feels greater than the distant benefit. The financial world is full of these irrationalities. Stock markets swing wildly based on emotions, not just fundamentals. Cryptocurrency bubbles inflate and burst based on social media trends and celebrity endorsements. As economist Robert Shiller notes, the market can remain irrational longer than you can remain solvent. This insight has made fortunes for investors who understand human psychology and lost fortunes for those who assume everyone acts rationally. The implications are profound. If people aren't rational, then pure free market solutions might not always work. Sometimes we need nudges, gentle pushes toward better decisions, or regulations that protect us from our own worst impulses. In 1958, New Zealand economist Bill Phillips made a discovery that seemed to solve one of government's biggest headaches: the relationship between unemployment and inflation. Phillips found that when unemployment was low, wages rose, people spent more, and prices went up. When unemployment was high, the opposite happened. It was beautifully simple. Governments could choose their preferred mix of unemployment and inflation. Want lower unemployment? Accept higher inflation. Prefer price stability? Live with more joblessness. It seemed like the ultimate policy tool. For over a decade, governments used the Phillips curve like a thermostat for the economy. The Kennedy and Johnson administrations in the US deliberately ran budget deficits to reduce unemployment, accepting inflation as the price. Then the 1970s happened, and everything fell apart. Suddenly, America and much of the world experienced something that shouldn't have been possible according to the Phillips curve: high unemployment and high inflation simultaneously. Economists had to invent a new word: stagflation. What went wrong? Nobel laureate Milton Friedman had predicted this exact scenario. He argued that people aren't stupid, they adapt their expectations. Here's how it works. When the government tries to reduce unemployment by spending more money, workers initially see higher wages and work more. But as prices rise due to increased demand, workers realize their purchasing power hasn't actually improved. They demand even higher wages to compensate for inflation. This creates what Friedman called the expectation-segmented Phillips curve. The relationship between unemployment and inflation isn't stable, it shifts based on what people expect inflation to be. Paul Volcker, Federal Reserve Chairman in the early 1980s, proved Friedman right the hard way. To break the cycle of stagflation, he deliberately triggered a severe recession by raising interest rates to nearly 20%. Unemployment soared above 10%, but inflation was finally tamed. The 1990s brought another puzzle. Unemployment fell to levels not seen since the 1960s, but inflation remained low. The Phillips curve seemed to have flattened or even disappeared. Fed Chairman Alan Greenspan called this the new economy. Technology and globalization had changed the rules. Increased productivity meant the economy could grow faster without triggering inflation. But as economist Larry Summers warns, the Phillips curve isn't dead, it's just sleeping. Recent years have shown that when unemployment gets very low, wage pressures do eventually emerge, just as Phillips originally observed. The lesson? Economic relationships that seem ironclad can shift when people change their behavior and expectations. As John Maynard Keynes reportedly said, "When the facts change, I change my mind." What do you do, sir?